you think about today, we view from a long-term investment perspective 3 themes taking place. First of all, given the fact that we basically borrowed growth from the future. So given quantitative easing 1, 2, and 3, by borrowing growth from the future, we expect market returns to be below expectations going forward. Second of all, given increasing geopolitical risk, we see much more market volatility. And third of all, in a rising rate environment, we expect unexpected consequences to take place. Given this perspective, we do believe asset allocation is shifting. Old asset allocation, what we learned in school, was much more backwards looking, statistically driven. It was much more focused on the long-term perspective. It focused more on asset class diversification. And generally, if you wanted to build an asset allocation portfolio, you tended to look at statistics such as standard deviation. I could build a portfolio that's more conservative than the benchmark by having a lower volatility. Asset allocation today, on the other hand, we feel it's much more dynamic. You need to be more dynamic in your portfolios. You need to both balance statistics and forward macroeconomic data. Third of all, you need to be focused more on asset risk diversification. What's your exposure to the housing market? What's your exposure to rising rates? And lastly, you want to hedge out the unexpected consequences, that what we call the fat tail risk, so the increasing use of alternative investments. So in our portfolios today, all of our portfolios for our clients have an allocation to about 20% to alternatives, commodities, REITs, maybe market neutral, global macro, absolute return, a diversifier to hedge out some of that risk. Question. So for us, you build an asset allocation portfolio, but you need those investment vehicles to populate each asset class. And once you select a manager, work has really just begun. So qualitatively, the reasons to fire a manager include process change, a portfolio manager leaves, a change in philosophy, or the portfolio is just not acting how you expect it to. Quantitatively, what we do at Cetera is, first of all, if a fund is in the 50th percentile or worse over 1 quarter, we're talking with a fund manager saying, hey, what's going on in your portfolio? Why are you struggling? If it's over 6 months, then we're doing a formal review of the portfolio, looking at holdings, attribution, performance, etc. And if this lasts over a year, we're on the plane flying out to visit the manager, having the manager come in and sitting down and saying, okay, let's revisit the initial recommendation from soup to nuts, from beginning to end, why we're recommending the fund.